Okay, so welcome to today's class. So today we're going to cover valuations, and in this valuations class, and this is class 8 of 8. So what we're going to do in this valuations class, I'm going to do a very basic question because I want to show you the different types of valuations that can be calculated. Then I'm going to share with you guys so you have the valuations question that I done with semester 1, and that covers PE as well as free cash flow. Okay, so though the question I'm going to cover today is very basic, but it has important principles that you need to be aware of. So I want to cover it, and I'm also going to share with you. I can't share with you free cash flow relating to CTA because that's on another level. But I'm going to share with you a class I did with the CTA guys last night that covers PE. So it's going to be fairly similar to what you cover in MAC3702. So basically, you have two PE questions and a free cash flow question. And then please make sure that you work through the exams I shared with you. And if you have any questions, that you actually contact me. Now, and remember, from now up until your exam, you have access to me. Like if you have any questions, then you can ask me. We can set up like a one-to-one 20-minute session. So I'm gonna have like 15 to 20-minute sessions available one-to-one if you have specific questions. If it's more than one person that have the same question or similar question, then I'll set it up as a group. So try to make use of it, but obviously you must come with a question that you have covered and you are uncertain as to what how they got to an answer, or how do you get to a particular answer. Okay, so those type of stuff. So what you must know, there's quite a few valuation methods. So you have the PE multiple, you have the free cash flow method, you have the dividend growth model, you have the net asset value method, you have market capitalization. So those are generally the 5 that they will test. Now, market capitalization won't come through in valuations because it's not really a valuation method. Market capitalization will generally come through in WACC. What is market capitalization? It is just basically the number of shares times the share price. So that is not a valuation, but just be aware that is also how you can calculate a quick value of a company. Okay, so just be aware of that. So the 5, in no particular order, but number 1, PE, number 2, free cash flow, number 3, dividend growth, number 4, net asset value, and then number 5, market capitalization. Now, market capitalization, as I said, will most likely be tested in WACC and not in valuations because it's not really a valuation method. Then you have net asset value. Net asset value is basically assets minus liabilities, which is basically equity. Now remember, net asset value, which is equity, is a number based on the balance sheet. So you're getting a balance sheet and you either have total equity or you have total assets and you have total liabilities. So net asset value, assets minus liabilities, is the same thing as equity. Just think about the accounting equation. Assets equals equity plus liabilities. So if you rearrange the equation and you say assets minus liabilities, it equals equity. So just be aware of that. That is net asset value. Now, net asset value according to accounting is purely based on the balance sheet, but the net asset value method according to financial management is slightly different. How is it different? From an accounting perspective, we just look at the balance sheet amount, which is based on historical values. From a financial management point of view, we want net asset value, but at market value. So what do? We will generally start off with NAV. We'll start off with a net asset value, which is either equity or which is either assets minus liabilities. And that is basically NAV according to the balance sheet or the statement of financial position. Then you will have to make the necessary market value adjustments, because what do we want? We want NAV according based on market value. So generally, if it's a big NAV question, it's 5 marks. Okay, that's a big NAV question, 5 marks. So you must just be able to be aware of it. What's important, NAV should not be your main valuation method. The net asset value method should only be used as a reasonability check, not as your main valuation. Okay, so just be aware of that. So that is market cap, that is net asset value. And now we come into the 3 big ones, which is PE multiple, which is free cash flow, and which is dividend growth. Now, free cash flow and dividend growth is fairly similar as to how we set it up. Okay, so free cash flow and dividend growth is fairly similar as to how we set it up. So I'm going to take you through that, and then you're going to see the formula is basically the same with about two to three differences, but these differences are significant. Okay, so just be aware of that. So I'm going to take you through, and then I'm also going to talk you through the PE multiple. So I'm not going to do the question. I already did the question, so I don't want to redo the same question. And those 2 questions is good for you to work through and handle any other free cash flow, any other PE multiple. So I'm going to do a very basic question, which is an important principle that I want you to be aware of. But before I get into that, let me just show you how we do free cash flow and dividend growth, or the 3 valuation methods. I just want to open up Google Sheets. Okay, so let me just share this quickly. As an email, what do you call it? Dale, the address. Just give me a moment. Okay, just quickly do this. Okay, so let's have a look how we're going about doing this. So when you so the three main valuation methods is going to be like that's going to draw marks like 15, 20 marks. Is going to be PE and free cash flow, maybe dividends, but let's say dividends as well. Okay, so PE multiple. So PE multiple, free cash flow, and then dividend growth. So what you must know in valuations is generally going to be these two over here, because remember market cap and dividend growth can be tested in WACC. So just take note of that. Okay, so the principle of dividend growth can be tested in WACC. So we want to calculate the value using the PE multiple. So we're going to say, so for the PE multiple, it's going to say PE, value equals PE multiplied by maintainable earnings. Okay, so PE multiplied by maintainable earnings. So what you should know is that the PE will generally be a PE from a comparable company, and then you must make adjustments to it in order to get to an adjusted PE multiple. The adjusted PE multiple is what you want for your company. Then we have maintainable earnings. Maintainable earnings is basically the profit number, the profit after tax number for the company you are looking at. However, included in that profit number could be items that won't take place in the future. So it could be once-off irregular items, or it could be market value adjustments. So you want a number that is sustainable, that is maintainable into the future. So therefore, you will most likely have to make adjustments. Okay, so that is how you'll get to the numbers. So in the video that in the valuations video that you have, we went through that in detail. So watch that and you would see how to go about doing it. So just take note of that. So how are you going to get the value? You're going to say PE times maintainable earnings. Then for free cash flow, the formula we use for free cash flow is as follows. Value equals free cash flow multiplied by 1 plus the growth rate divided by WACC minus the growth rate. So what you're going to notice, you're going to need a free cash flow number. So they will give you a free cash flow number, or they'll give you a profit number, and you will have to make adjustments to get to a cash flow number. Okay, so on a CTA level, it's a little bit more complex, but for our purposes, it is quite straight. For MAC3702, it is quite straightforward. All you're going to have to do is start off with a profit number and then remove any non-cash flow items like depreciation, and there may be other type of adjustments that you need to make as well to get to a cash flow number. The type of cash flow number we want is not any cash flow number. It must be an operational cash flow number. It must be a cash flow number relating to operations. So if there's an amounts included in that cash flow number that is from investing activities or from financing activities, you will have to take it out. Okay, so just be aware of that. Now, you will have a cash flow number of the current year. We don't want cash flow of the current year. We want cash flow of next year. So to get cash flow of the next year, we must grow it by the growth rate. And that's why we say 1 plus the growth rate. Then we divide it by the WACC rate minus, once again, the growth rate. Okay, so just take note of that. For the dividend growth model, it's a similar formula. Dividend growth model, it's a similar formula. Say value. Instead of saying free cash flow, we say dividends. Okay, so instead of saying free cash flow, we say dividends. Then we multiply it by 1 plus the growth rate. Because we don't want the dividend, the current dividends, we want the dividends of the next period. And that is why we divide it by the we grow it by we increase it by the growth rate. Then we say divided by, instead of using WACC, we don't use WACC, we use cost of equity minus the growth rate. So you can see the formula is basically the same. It is just the number we use for over here for free cash flow is the free cash flow number, whereas for the dividend growth model, we're using dividends. Then in the denominator, for free cash flow, we use the cost of capital, the weighted average cost of capital, whereas for the dividend growth model, we use cost of equity. So that is the significant difference between the two. Okay, so just be aware of that. So now you're going to see how we're going to do this formula. And the way we're going to do this one, you do exact same, we do a free cash flow. So I'm going to go into a very, very basic example, but this basic example is critical because then the teacher is going to teach you an important concept. Okay. So before we, because I'm just going to go on into that. Where did I have it now? So here we have a 12-mark question, which is quite basic, right? But I just want to show you the importance of this example. So they're saying the following information relates to K Pty Ltd. The latest dividend declared and paid in 2013 is 550,000 Rand. The expected growth rate in dividends for 2014 is 10%, 2015 is 15%, 2016 is 20%, and 2017 and thereafter is 25%. They say 28% is a fair rate of return. 28% is a fair rate of return on minority shares. Just give me one moment. I just have a call with the college quickly. Hi guys, thank you for waiting. I just needed to take that call from the college. Um, so where was I? Okay, so what I want to share an important principle from this basic question. Okay, so it is a basic question, but it's gonna bring through an important principle that it's not necessarily that many of us would get not get right. Okay. So what you must understand, and this is applicable for free cash flow as well. Okay. Generally, in a valuation, in a free cash flow valuation, and like in this case, in the dividend calculation, we have something known as a two-stage approach. A two-stage approach is where the first stage is this over here, where you have different growth rates. Okay. In the real world, you want this first stage, we call it the explicit period. You want this first stage to be as long as possible. And generally, the longest period would be as far as you can accurately forecast. Okay, so that is known as the explicit period. Then we have the second stage, which is this stage here, which is the year from which the growth would be constant. So as you can see, the growth over here is constant at 25%. So you might just be aware of this. In most cases, what we get is just basically a dividend that will have the same growth rate forever and ever. But the moment you have a question where dividends or even cash flows is growing at different rates, and then after a certain time, it grows at a constant rate. That is known as a two-stage approach. In the real world, it can be like a multi-stage, but for our purpose, we'll go as max as a two-stage approach. Okay, so that's very, very important. So this over here, where the growth is different, is known as the explicit period. This here, where the growth becomes constant, is known as your terminal value or your continuing value. Same thing. Okay, so just take note of that. Okay, so that's the first thing. The second important thing I'll explain when we do the question. So now I'm going to answer the question. So where did I have that now? Okay, so now I'm going to answer this question. Okay. So with any valuation, we would have the detail, or not any, but like the free cash flow dividend growth, we'll have here details year 0. Then we have the explicit period, which is year 1, year 2, and year 3. Okay, so you will show your explicit period. In this case, the years was 2014, 15, and 16. Okay, so 2014, 2015, 2015, and 2016. Okay, so we will have our explicit cash flows in this question is dividends. So the only explicit cash flow is going to be dividends. If this was a free cash flow question, explicit cash flows would be, for example, every line item in the income statement. So for example, sales, cost of sales, give you gross profit. Then you will take into account operating expenses and so forth. Okay, so just be aware of that. In this case, the explicit cash flow is dividends because it is we do using the dividend growth model. Then the next is going to be, is our terminal value. Okay. Now, what we will do, we will have the actual dividends. So I just want to do this over here. So growth and in 2014, the growth rate is 10, 15, 20, 10, 15, 20. So it was 10% over here. It was 20%, 15% over here. And then 20% over there. Okay. I just do it over here because I'm using Excel. It's just easier for me to have it like that. But this is basically, this is the actual calculation. I'm just using that over there. So it's easy for me to apply the formula. Okay, so the dividends. So the most recent dividends was 2013. Okay, so the most recent dividends was 2013. We don't put anything in year 0 because we only focused on the future. Year 0 now is in the past. Okay, so the most recent dividends was 2013, which was 550. So I'm going to say 550, 1, 2, 3, but I'm going to increase it by the growth rate. Going to increase it by the growth rate, which is 10%. What happened over here? Oh. 1 plus the growth rate. Okay. Then in year 2, it's going to be not 550, but it's going to be that multiplied by 1 plus the growth rate of 15%. Okay. And then I will just drag it across because it's going to do the same calculation. Okay, so the calculation is going to be the same, that plus the growth rate. So that is my the explicit period, the cash flows of the explicit period. Now I must do the cash flow of the terminal value. Now this is the important aspect. So let me just show you the calculation for a terminal value. What am I doing now? So the terminal value calculation is basically this calculation over here. This is the terminal value calculation if you're using a free cash flow method. This is the terminal calculation if you're using a dividend growth model. Okay, so the terminal value equal, because you're using a dividend growth model, it's going to be D3. What did I do there? D3 multiplied by 1 plus G divided by KE minus G. Okay, so the terminal value is using this formula over here, which is for the dividend growth model, it is that. For the free cash flow, it is that. That is why it's important to ask yourself, is there an explicit period? An explicit period means that you have specific cash flows and different growth rates during a certain period. And then thereafter, after that certain period, cash flows and growth rates remain the same. Okay, so just be aware of that. So, so just take note of that. So that means to get my terminal value, I need D3. D3, why do I have D3? I take the last cash flow of the explicit period. So the last cash flow of the explicit period is year 3. Now call it D for dividends. Okay, so this is dividends of year 3. If I was using the cash flow method, this wouldn't be called dividends. This would have been called free cash flow. Then I'm going to say free cash flow year 3. That is the last dividends, or it's the last cash flow of the explicit period. Okay, then I want the growth rate. They gave us the growth rate for the terminal value. Remember, the terminal value comes into play when things become constant. So it comes into play from 2017 onwards. When does things become constant? From 2017. So what's the growth rate from 2017? It is 25%. Okay, so that's what they told us. Let me just check that. So that properly. 25%. Okay, so you see 2017 and thereafter, when you see the word thereafter, when you see for the foreseeable future, that means from 2017 and forever and ever, it is now constant. So that tells you you are in the terminal value, the continuing value territory. Okay, so the word thereafter or foreseeable means forever and ever. Okay, so then we need KE. KE, they gave it to us. That is this amount over here. 28% is a fair rate of return. Okay, so that is the fair rate of return. That is your cost of equity, and it is 28%. D3, I'll just take from the answer over here. Now I can work out terminal value. So terminal value equals terminal value equals D3 multiplied by 1 plus the growth rate. Okay, so I'm just looking at the formula I typed up at above. Okay, so I'm going to put this all in brackets. Divided by cost of equity, which is 28, minus the growth rate. Okay, so there we go. So as you can see, the terminal value is always going to be a large number. Okay, and that is why in the real world, they want the explicit period to be as long as possible so that you're having actual cash flows that you can forecast, because the terminal value is just estimating that things are going to remain the same forever and ever. And the terminal value usually accounts for the biggest part of the, well, not usually, it does account for the biggest part of the valuation. And that is why, to make sure that it's not as big, they want to have this explicit period as long as possible. Okay. Now here is the second principle that I want to bring to your attention. The terminal value will go into the period of, will go into the last explicit period. Okay, so remember the last year for the explicit period is year 3. So the terminal value goes into year 3 and not into year 4. You don't put the terminal value into year 2017. Okay, so that's very, very important. You put it in the into year 3. So wherever your cash flow is D3. You plug it into that year. So you plug it in to the last year of the explicit period. So this year is an important aspect, because there are 2 typical mistakes people will make. One, they'll plug it in over there, which is wrong, or they will plug it in 2017, which is also wrong, given that we used D3. If you used D4, then you will plug it into D4. But in this case, we used the cash flow of year 3, so therefore the terminal value goes into year 3. Okay, very important. There's a better explanation, but I'm not going to go into that detail. I'm not going into that detail. Okay, I was going to talk from a simplistic way. Now we can work out our total cash flows, well, total dividends. Okay, so total dividends, or total cash flows, whatever you want to call it, doesn't matter. Okay, so it's equal to the sum okay, now we don't want future cash flows, we want a value today. So in order to take this future cash flows and get a value today, we have to discount these future cash flows using an appropriate discount rate. The appropriate discount rate for dividend growth is cost of equity. Okay, so remember that the appropriate discount rate for the dividend growth model is cost of equity. The appropriate discount rate for free cash flows is WACC. Very important. So the discount rate, cost of equity, given to us as 28%. Okay, and this is going to give me my value according to the dividend growth model. value according to the dividend growth model. But what's important, this represents 100%. Okay, so all I'm going to do is I'm going to say using Excel, NPV or Google Sheets, I put in my discount rate and then just the cash flows. Day one from cash flow 1. So there we go. Okay, so the value of 100% is 17 million rand. Okay, but what do we don't want 100%. So we want a value of 10%. That's what the required wanted. So all we're going to say is 100% value multiplied by 10%. So this is typical that can happen in an exam, is that they can ask you for a certain percentage that you're acquiring. Maybe you're acquiring a 70%. So you get your answer you're going to get is 100, but then you must multiply it by the 70% in order to get the value you are looking for. Okay, so this is the important principle. You need to pick up whether it's dividend growth model or whether it is free cash flow, whether you have an explicit period or not. If you have an explicit period, you must follow the two-stage approach. Stage 1, the cash flows for the explicit period, and then the terminal value. If there is no explicit period, we'd have simply just do this calculation over here. Okay, we'd have simply just do the working one calculation. Okay, so just be aware of that. Now, the second thing, you must take note that the last year of the explicit period is year 3. So the terminal value will go into year 3. Okay, so just be aware of that. So that is the two important things I wanted to mention over here. And then just remember the difference between dividend growth and free cash flow. If I go back to this tab over here, in the free cash flow calculation, we're using free cash flow and the discount rate is WACC. In the dividend growth model, we're using dividends as the cash flow and the discount rate is cost of equity. Other than that, the formula is the same. Okay. So that's all I wanted to cover for today, because the valuation question I shared with you from semester 1, it covers both free cash flow and PE. So please work through that. If you have any questions, then ask me. And then I'm also going to share with you a class I had yesterday with the CTA guys. It's a bit long, 3 hours, but you don't have to watch it full 3 hours. The first part of the class is we did a PE evaluation. Now that PE evaluation is fine for a MAC3702 class, so you can work through that one as well. Okay. Yeah. So if you have any questions, then let me know. So remember, this is the last class of the 8 classes. So ideally you want to work through, I think I asked you to do at least 1 or 2 questions before next week. And then so that when next week, Tuesday, Wednesday, Thursday, we're going to do the revision class. I'm going to work through the exam of 2021 that was written now in June, July. I'm going to work through that. So I'm going to work through that over 3 days. You have the videos where I worked through about 1 or 2 exam question papers. And then I also asked you to work through those that 2019 and 2020. Now, in the videos of first semester, I worked through 2020 and 2019, maybe not the entire papers, but questions of those. So work through that, watch the videos, and then see if there's any questions you still have you want to ask me. Like I said, from now until the exam, you can set up 15-20-minute one-to-ones with me if there's any specific question you have. So remember why I wanted 15-20 minutes. So I'm not here to go through the entire question paper with you. It is basically an aspect of a question. So let's say you work through a 50 marker, and all the 50 marks, there's a WACC question. And within the WACC question, you struggled with something. You want clarity on that. So we use that sessions for that. Okay. If I find that it's a concept that many's asking me about, then I'll set up a group session. So please utilize the one-to-ones, and then and so you can ask me any specific questions that I can help you specifically and see if there's any gaps I can bridge for you. Okay. So do you have any questions? Sinclair, Talita, Dane.
I'm good. Thanks. I still need to work through those questions out.
I can't hear. I can't hear.
Sorry, I said I'm good. I still need to work through those questions out over the weekend.
Yeah, no problem. Delete. Simply. Is you have no questions and all good? Yes, certainly. I didn't hear you. But I'm assuming you're good. Okay, guys, all the best. Please try to practice. Remember, there's no need to run through a million questions. It is to do a few questions, but with high quality, and that is what's going to get you through the exam. Because remember, no matter which question you cover now, the chance of it coming in the exam highly unlikely. The principles being tested is going to be the same. So that is why we focus on quality. You're going to be able to get a deeper understanding of the principles being tested. And that is what's going to help you to answer anything that comes your way in the final exam. But remember also, you must practice to write under time pressure. So if you're working through only 3 papers, 2 of them work, take your time, although you try to tell yourself that you want to work as quickly as possible. But time must not be the main objective. In the 3rd paper, you need to make it the objective as if you're writing the exam. Okay. Okay, guys. See you. Bye-bye.
Thank you. Bye.
Bye-bye.